Understanding mortgage rates today is crucial. Joining me is mortgage expert Ryan Montez with Change Home Mortgage to tackle the top 5 questions on everybody's mind. This is Lauren Roberts with Berkshire Hathaway Home Services. So Ryan, let's start with a broad question. How do current interest rates affect monthly mortgage payments?
Lauren, on a high level, the interest rates can have a significant impact on your monthly mortgage payment. The two major components of your monthly mortgage payment are the interest and the principal. Higher interest rates increase the interest portion of your payment, while the lower rates decrease it. Since the monthly mortgage payment typically includes both principal and interest, a higher interest rate means a higher overall monthly payment, while a lower rate means a lower monthly payment. So for example, if you have a $200,000 mortgage with a 30-year term at an interest rate of 3%, your monthly payment would be around $843. At an interest rate of 5%, your monthly payment would be around $1,073. Even a small change in interest rates can significantly affect the monthly budget.
So clearly the higher interest rates impact buying power and home affordability. This is definitely top of mind for our clients. How do the higher interest rates we are seeing impact buying power and home affordability from your perspective?
Absolutely. Well, rising rates affect home buyers in several ways. First, you have reduced buying power with the lower loan amounts. When interest rates rise, the amount you can borrow decreases. This means you can afford a less expensive home while maintaining the same monthly payment, unless you bring in a large down payment, of course.
Yeah, that makes sense.
Secondly, there's the increased monthly payments that we just mentioned. If your budget for a monthly payment is fixed, rising rates force you to look at less expensive homes, keep your payments within your monthly budget. And then lastly is the overall affordability. Higher interest rates can make homes less affordable overall. If rates rise significantly, and even if a home price does not increase by that much, the cost of the borrowing to buy of the home definitely goes up.
Yes, interest rates have a huge impact. According to Fannie Mae, we may see mortgages a little over 6% until maybe even up to the end of 2025. Should buyers lock in interest rates now or wait to purchase for years to come?
Well, Lauren, this is a very turbulent time right now with mortgages and rates. I suggest locking your rate right now, which is usually how we move forward. In my mind, there are two main reasons for this. One, you don't want to get caught in a higher rate environment, further diminishing your buying power or pushing your property out of your budget. You can always refinance in the future to capitalize on the lower rate when they ultimately come down. But if they continue to go up, you will be happy that you locked in at the lower rate.
Totally agree with you on that.
Number two, not purchasing now due to rates can be a gamble because of what's happening in the current housing market. With such limited inventory right now, you run into the risk of purchase prices going higher. Refinancing is always a way to bring down your rate, but you can't fix purchasing at a higher price.
1000% again, agree with you. So just in the last year here in Orange County, homes went up 12.1%. Right now in Huntington Beach, we have limited new builds given the cost of land. Our city is a magnet for investors, and we're seeing the boomer generation more inclined to stay in their homes, therefore keeping the inventory tighter. These things can push up prices. Okay, let's play out this hypothetical of waiting for interest rates to get to 6%. Let's assume you have a house today that's worth $2 million, and in 2 years, the home prices increase 12.1% each year. Let's assume 20% down on that home. The cost per month would be around $12,000, a little bit over that. If you waited to buy at a lower rate, let's say you bought today at 7.5%, you're paying a little over $11,000, which is less than had you just waited. Going off of just one number, just mortgage rates, can steer buyers in the wrong direction.
I totally agree with that, Lauren.
So Ryan, let's talk specifics on mortgage types. What types of mortgage specifically at your spot are available to buyers, and how do the interest rates differ between them?
Well, Lauren, there are several types of mortgages in the market right now. First are the types which most people are familiar with. This includes your FHA, your VA, your Fannie Mae or Freddie Mac, also which are your conventional loans. These are the loans which will typically have the most aggressive interest rates for our consumers. These include your 30-year fixed, full document loan types, and then which lead into the next category of which are our jumbo loans. These are for your higher loan balances for properties that exceed our area's county loan limits. Because these are higher loan amounts, they typically have more stringent qualifying guidelines and can vary from investor to investor. Third, these are what we call our non-QM loans. These include programs such as our DSCR loans, our bank statement loans, or various other alt-doc loans. These are often offered to clients that have a regular income and couldn't otherwise qualify for the typical home loan. They can be a very useful tool to allow borrowers to purchase their homes due to the creative financing and the underwriting guidelines that these typically have. They can then work on adjusting their income and refinance into a conventional loan in the future. future. Frankly, we could have an entire segment just on these loan types alone.
Well, we'll have to have you back. Okay, last question for today. What is the long-term outlook for interest rates and how should I plan my purchase accordingly?
Well, Lauren, none of us have a crystal ball, but heading into our future outlook, recently reporting confirmed a strong employment sector and offered little encouragement that inflation is nearing the Fed's 2% target. This definitely does not help our rate cut prospects for 2024. 1 or 2 rate cuts are still expected in 2024, with the September and November Fed meeting likely being the earliest for that to occur. However, a cut this year is definitely not guaranteed. 2024 is very much contingent on the data. The current expectation of at least 1 cut before year end provides us some rate improvement. Optimism, although, may not transpire until Q4 2024 or even 2025.
Yeah, that's what I've been hearing. Amazing. Well, thank you so much, Ryan, for sharing all of your insights. You're an exceptional partner, and I'm glad we got to learn from you today as we think about the housing industry. Folks, if you have any questions on buying or selling real estate, mortgages, please don't hesitate to reach out to me. Ryan and I are here to help you and keep you up to date with the latest when it comes to what's happening in the mortgage and real estate market. Again, this is Lauren Roberts, your modern realtor here at the Coast. And this is Ryan with Change Home Mortgage. Reach out to us if you have any questions.
Thanks so much, Lauren.